Welcome to Spotlight on Community. My name is Lynn McEntee, and I'm very happy to host you today. We're back for talking about financial literacy through the Moksha Canada Foundation, and we want to thank Moksha Canada Foundation. We are here because of Moksha Canada Foundation, and we want to thank them for allowing us to do this Spotlight on Community program, which is a 28-week program where you've been viewing some of our different themes and segments to be a part of learning from guest experts in Ontario and across Canada. I'll tell you a little bit more about Moksha Canada Foundation if you're just joining us for the first time. We're about connecting, creating, and participating with our communities. We celebrate multiculturalism, respecting diversity, and having inclusive approaches to service delivery. Hence, our work aims at building, facilitating, and promoting connections amongst the diverse communities across Canada. Please get involved in Moksha Canada Foundation and join us. Welcome to Spotlight on Community, and we are welcoming back our guest experts again for financial literacy. We're picking up our conversation on middle age and financial literacy. And I wondered if we might pick up our conversation with Priti. Priti, we were talking about RSPs before, and if we could just kind of start there and remind our viewers what we were talking about in terms of RSPs and some options.
Absolutely. So I was talking about RSPs earlier in the segment, and just to kind of reiterate again what RSPs are, it's a registered retirement savings program that is offered through most banks. And it is a government program where people can take advantage of contributing to the RSP so that they can save for their retirement and also be able to get a tax deduction on the income that they earn. So again, the example that I shared previously was, if your income is, let's say, $50,000, and if you contribute $5,000 to an RSP, that you will actually only be paying tax on the $45,000, as you will get a rebate for that, potentially get a rebate for the additional $5,000 that you've contributed. So that is actually a really great, program that's out there. Everyone should be looking at investing in RSPs just for their future, as well as taking advantage of, different other programs such as tax-free savings accounts as well. And the benefits, of course, for that is the ability to, make or invest your money and then make money and then not have to pay taxes on the additional money that you've earned in your investment.
Tax-free savings. Interesting. Okay, so you could have both parallel at the same time happening. You can have your RSPs.
Yes,
and you can have your tax. Yes. Okay.
Yes, you can. Yeah.
That's awesome.
So RSPs, typically I would recommend that if you do start working and you have a taxable income, that would be really great to, kind of start with an RSP. Tax-free accounts, you don't necessarily have to be working. You just really have to have some savings or investments that you want to be able to purchase and earn income on, and that's basically a tax-free savings account because you don't get that deduction like you would for an RRSP.
I see. And when you have the RRSP, how does that help you when you do your taxes? Can you just expand on that a little bit more? Yeah, thank you.
Yeah, so typically what would happen is you would do a contribution. So every year you're allowed a maximum contribution. You don't have to do the maximum. When you do that contribution, you would get a tax receipt from the bank. And basically, just like, you would, when you do your taxes at the end of the year, you would accumulate the tax receipts and, that sort of thing that is sent to you from where you did actually purchase the tax receipt. So let's say, for example, you went into your bank, contributed $5,000 into an RSP. That bank would then send you a tax receipt for $5,000. You would file your taxes with that, and to be able to kind of reduce your income tax that you're paying on that.
And Priti, if you could just remind our viewers where you're from and what organization you're with.
Oh, absolutely. So I actually work for one of the big 5 banks. I work for TD Bank, and I'm a senior branch manager. Been with the bank for about 25 years now. Started off as a teller and sort of worked my way up into different positions, and that's now what I'm doing. Love what I'm doing. I coach a team, I mentor a team, and really just help customers with like their investing and borrowing needs. and just really building relationships and, sales for the bank. So that's what I do.
Very cool. That's awesome. Thank you so much. Would you mind if I keep asking one thing about RSPs?
Yeah,
if you don't mind, is it too late to start? When is it too late to start an RSP, or is it ever too late to start an RSP?
I would say the earlier you start, the better. So you could be as early as 18, 19 years old, depending, but really the gist of it is once you start earning an income, that's when you want to start, saving an RSP. Now, it's not like, the previous example where I said you contribute $5,000, because not necessarily people will have that kind of money to invest one shot. There's different programs available where you can actually, invest little by little. So there's pre-authorized purchases that you can do, let's say from your bank account on a weekly, monthly, bi-weekly basis, if you will. Typically what I always recommend is when you get paid, always try and, set some money aside. We talked about budgeting before. Set some money aside to be able to contribute to that RSP. So it could even be as little as $25 a month or $25 every week or bi-weekly. And then that would just go towards, investing in an RSP. The benefit to that is that it grows over time, and really you're not going to miss that $25 or $50 or $100 if it's coming out systematically from your account. So that's one of the biggest things that I would recommend or advise to anyone that's actually starting off. You can really invest in an RSP at any age, but the earlier that you start, it is much beneficial because your money will grow a lot faster.
Oh, that's awesome. Great answer. Thank you. All right. Sunil, do you have any questions at all? Yes, you're good. All right. And I just kind of wanted to move into sort of investing in a house and mortgages and such, if we can open up the conversation a little bit to all of our panelists today. And when should someone start thinking about investing in a house? When is too young? Is there, what age should you be, generally speaking? Yeah.
I'll take this one. I do this day in, day out, so I have some contribution. There's, you have to be legally, I think, 21 to own a title on a property, if I'm not making a mistake. But it's never too late to buy a property and never too early, depending on your objective. If the objective is to have a property as a nest for your family, whenever you're building your family, it's a good idea to plan few years before that. How would you get yourself into a primary home at that point? And as long, normally by the time you get out of university and get a decent job, paying you well, you're looking at you're probably around 22, 23 mark by the time you would look for a property. And if you listen to Auntie Priti in time and you built in RSPs and and you listen to Jyoti and put money in TFSA, over the years you might have your birthday money accumulated to something that could go contribute towards down payment. I'm going to give you a quick 101 on what do we look for. What do banks look for when we're lending money for a house? We're looking for three things. We're looking for, one, your capacity to pay. Your income will derive that. And your liabilities, all the credit cards that you were taking out when you were 16, 17, and you kept not paying on time is going to affect you borrowing money now, because that's your credibility with us. And then, moving right along with it, how much of your own contribution are you planning to make? Is it, you can buy a property with less as 5% down payment, but 5% on a 500,000 is still $25,000. So, those three factors are going to affect on what can we buy. And if you have that plan in front of you when you're coming out of university, you'll have a plan to save. But if you don't have any plans, you won't plan to save. So I highly suggest that, as you're getting out, look at your options. Some people's lives, house buying is, 30, 35 plus mark. They want to enjoy life a little, but whichever way you want to go, for saving for house, RSPs for down payment, TFSA for a down payment, paying your bills on time for your credibility, and income to pay your mortgage back to us would be a few things that the banks look at.
Thank you. And could you remind our viewers who you work for and what your background is as well?
Yeah, I work for one of the leading main 5 banks, and I work as a mobile mortgage specialist. So I've been serving for about 15 years and doing only mortgages So here I am to share back with our community on how to, by the time you get to call me or your advisor, I'm getting you to prep yourself better for that beautiful house that you're going to live in.
Oh, how lovely. Yeah. Oh, great guest panelists we have today. Thank you so much. Jyoti, I wonder if you might want to jump in terms of your comments and just commentary on mortgages and why you think it's important to maybe take on a mortgage or to plan for that in your lifetime.
You know what, I think it's so, I don't know what's the best way to put it. I think owning a house, it's a safety blanket. I think
Okay.
I know that culturally, like my parents, my family, my father till date believes that we should have our own brick and mortar. Owning a house is really important, making sure you have that as one of your biggest assets. And it obviously turns out to be the biggest purchase of your life, right? Although when I look at my own kids and I look at the generation today, we were talking to the Uber generation. They don't want to own anything. They would rather Uber around versus own a car. They would rather stay in an Airbnb or think about different things or rent versus own. So it really, at the end of the day, it turns out, or it works more around how we have our kids, how are we upbringing, like how is their upbringing, what is it that we're teaching them, how are we transitioning our values, our financial sense over to our kids. I think that's really, really important. And that's what's going to impact their future. Obviously, they're going to grow up to have their own opinion. They'll have their own friends to understand what they want to do. But I can say, especially for myself, I think, like I said, till date, my parents strongly believe we should at least own our own four walls and, have a house. And then anything beyond that, really, if you want to build an empire on real estate, hey, then you build, save up for the next condo that you want to rent out, or save up for the next, investment property. And, culturally, it happens in many many generations that, they can and they do build their net worth based on real estate. But again, the trend is changing. And I think the only thing what I will say is the values that we pass down, and that includes a financial sense as well.
Oh, that's beautiful. That's really, really nice. Thank you. Very well put, actually. Thank you so much. And Jyoti, for our viewers that are just joining us, maybe didn't get a chance to see us the last segment, could you let our viewers know where you're from?
Yeah, so I'm Jyoti and I work for one of the big 5 banks as well. I am a senior manager and I've worked with the bank for about 24 years now. So long time servicing the financial needs for our customers and our community. So I'm really glad to be here.
Thank you. Thank you so much. And Priti, any comments about the importance of taking on a mortgage, perhaps, and tackling that challenge in life?
You know what, I think both Jyoti and Raja made really great points. The main thing that I would add, I guess, or the only thing I would add in addition would be just really focusing on that savings, right? Because without that, it's going to be really tough to sort of own. And Jyoti made a great point about like what's going to be important to this new generation, right? So whether they do want to buy or whatever the case may be, right? It's always good to, have that savings there. And then, even if you start off small, so whether you start off with a condo or a townhouse and then sort of work your way into, maybe upgrading yourself into something bigger if you wanted to as you progress in life. But the main thing is really kind of establishing that savings that is so important.
I see. Yeah, thank you. Thank you all. Would this be an opportune time? Any questions, Sunil? No? Carry on. I was going to ask, yes?
Yeah, I have a question. Like, what is it important to buy the insurance for the mortgage?
Thank you. You're reading my mind.
Raja.
My question was, is it important to buy the insurance for the mortgage?
You could just mute it a bit. Sound cut out for some reason.
Can you hear me?
I know. Yeah. Thank you.
Sorry about that.
No, it's okay.
I think it's important to have insurance. Everybody should have insurance. We have car insurance, we have health insurance, we have all. It's very important to protect your debts. So because mortgage is the largest debt that you own in your life, It's very important to make sure that that's protected by insurance. In case of the unforeseen happening, your family is not left with a large debt. Whereas, in case, while the family is grieving, going through the process, last thing on their mind is who's going to make the mortgage payments. So absolutely, I highly suggest everybody to look at the options available to protecting their debts. You can do via mortgage insurance, which is a very easy product to get with the banks. There's also other insurance options available. Definitely do research it, but you definitely need insurance when you borrow money. Absolutely.
No, thank you for that. Jyoti, did you want to say
Thank
something? Okay, thank you. So insurance obviously being very important. Thank you, Sunil. That was up in my brain already. Thank you. Appreciate that. What are some of the types of mortgages then? And if you could, for somebody who's never done this before, like I have myself, but for anybody who's maybe just viewing for the first time and thinking about it, should they start small? Should they start with a small purchase? Maybe flip the home, or is that something they maybe could take on that's attainable? Do you recommend that?
Great. Absolutely. I feel like I put that in your head. That's a great question. So what I suggest is that everybody has a subjective plans and subjective needs for their real estate portfolio. Let's call it that. And it all really depends on where do you want to be. So it's very important. All those habits that we built as a kid, as a teenager, as a university going student, and now we're implementing it. You might get to a point where, this might be something that you want to explore to build further investments in. But, there is no one per suggestion, buy a condo, it's a great start, or buy a house, it's a great start. Like the trend is changing. Like I'm saying, cohabiting is a new thing that's happening, where brothers and sisters, both getting married or not unmarried, they're buying a property together so they can build their asset as one and then share it afterwards, because it's very hard to save or get qualified for a large property, in Toronto these days. So cohabiting is a new thing that's happening, and the new generation that's coming in, they're very savvy. They know, and I give the power to the kids, but the technology is giving them, technology is a really great tool. And I highly encourage everybody listening at a younger age and an older age to use that technology to educate yourself on how to manage. So I'm going to give you a quick 101 on mortgages now. And from this point on, you won't have any questions left. We look for, I've told you what we look for to qualify for a mortgage. Now I want to know, what is a mortgage? Mortgage in simple term is a big loan on your house, depending on what you contribute and what we lend as a bank or as a financial institution. And when you're repaying it, what determines your monthly payment is something called amortization. You would have heard this in your grade 10 course in math, where it talks about amortization and you amortize the length of the loan. So the payments could be manageable. The maximum amortization available in Canada right now is 30-year amortization. You could go lower the amortization, higher the monthly payment. Higher the amortization, lower the monthly payment. So that's a great way to look at it to see how you can budget yourself. And I wanted to mention one point that we missed in our segment 1 and segment 2. Priti briefly touched on it, is budgeting. Budgeting is so much more important if we have learned the right technique and skills in university stage. Implementing in real life, it'll make more sense saying I make $5,000 a month because I'm just coming out of university, and $3,000 will be my mortgage condo payment along with maintenance fees and property taxes. And now you have $2,000 left to pay for a car, transit, food, maybe go to somebody's birthday party. So budgeting is very, very important. So, in a condo, 3 things come into play: your mortgage payment, property taxes, maintenance fee, and then, your other expenses to live in there. In a house, you will have your mortgage payment, you'll have property taxes, but no maintenance fee because you're maintaining the property yourself by, cutting grass, cleaning snow, and all that kind of stuff. And then from there on, there are multiple other ways of investments. We can maybe do a segment 3 on that.
That's neat. That's awesome. No, thank you so much. Then question? No, we're okay. If someone wanted to purchase property when they're in university, could that work?
It could work for, somebody that is savvy enough, if they've been, educating themselves and they have the support system, but qualifying as a student might be challenging. As we talked in our first segment, that we need three things. We need income, we need credit, and we need down payment. You may be a smart kid and you have the down payment because you're Justin Bieber, or, you maintain your credit. But if you don't have income on a monthly basis to support your, we want to know, how are you going to pay the bills? You buy $1 million property and you put 900,000 in it. We still want to know, how are you going to make the payments on the $100,000? So it's all income-based lending. So as a student, you might need a cosigner, like similar to your student loan. Mom and dad bank might need to help out, or friend or an aunt. But otherwise, yeah, we do need income. So waiting it out might help, because there's a lot of pressure going through studying phase at university time. Do you really want to add one extra thing on your plate? Again, subjective. It's not something that I would suggest at that crucial junction in your life. But hey, kudos to you if you can do it and you have somebody to co-sign, for sure.
Cool. Thank you. Any other panel comments? Could we speak a little bit about insurance then, if you don't mind, the types of insurance that are necessary when you own a home, if you're going to take on that challenge, right? Do you have a house without any insurance at all? Is that recommended?
Wow, great point again. So I actually missed this. When you're buying a property, there is something called, obviously, Sunil, we talked about, getting your debt protected, which is your loan. In case anything happens, it's protected. Your family is not left with the debt. Then there's something called home insurance. Home insurance is there to protect your home in the event of unforeseen happening to the house. Sewer backage, fire, theft, water damage, anything like that is protected by a home insurance. And that is a must with all the closing in Ontario that happens. All the banks are looking to make sure that you have home insurance in place when you're buying a pretty big asset like that. So home insurance to protect the home, mortgage insurance to protect your debts, your loans, and similar to your life insurance, you have that. And then there's something called critical illness. I'll briefly touched on it. Critical illness is there, again, loss of life. In case anything happens, you go upstairs early, that is paid off if you have the insurance. Then there's something called critical illness, which is in case of you getting diagnosed with something serious, heart, stroke, something bad as a C word. I hate using it, cancer, those kind of events, there's a high probability you will survive with the medical systems that we have now. So in going through that kind of phase, if you're now well, last thing you want to worry about is your mortgage, which is a large amount of your check donation that goes to. So absolutely what I suggest is having a look at critical illness is very, very important, because it takes a while for you to recover and come back into workforce. So until you do, critical illness is something, again, another product that you can look at. So home insurance to protect home, life insurance or mortgage insurance to protect your debt, critical illness to protect you once in case you get diagnosed and your debt is paid off, and you can still go back into the workforce after that.
Raja, could someone come to you for that then, inclusive insurance and that guidance?
Absolutely. Majority of the banks as advisors, we are trained on, while we're giving money out, to make sure that we have a healthy conversation around, hey, have you thought about, I'm giving you an X amount of dollar in case anything happens to you. Your wife is stay home for the next year or two because she's having a baby. How would you handle that expense in case, how would your family handle that loss? So absolutely, that is a very healthy discussion to have at an earlier stage with the whole family when you're borrowing this debt. And we, without a fault, I have this with every single buddy that I lend money to. Again, an option should be there for them to know there are multiple options available, and then they can see what fits and suits their needs as a family.
Thank you. Anything from our panelists, other panelists at the moment? No? Okay, thank you, Raja. I appreciate that. That's awesome. No, you're just touching on all the things that we're thinking of. If someone has a line of credit, and let's say there's something with their home that's gone wrong, for example, and they have a line of credit and they need to use that line of credit to do repairs in their home. How would something like that work? Does anybody want to take that?
So depending on the amount of damage that you would have in the house, if it's a minimal damage, $5,000, $6,000, $10,000, I would say that would be a rule of thumb that you can manage with your own line of credit, which is personal line of credit, that if you maintain your good credit, Priti would have given to you that at the branch. But in case that, and that's why, again, the importance of insurance. If you had home insurance, that would cover that kind of damage that would have occurred if it's under the policy. Now, however, in case it doesn't fit into both of those, then, if the damage is large, you might have to think about maybe refinancing your mortgage. You borrowed 200 and maybe it's 50,000. 50,000 on a credit card is a lot to repay on a monthly basis, high interest costs. So maybe it makes sense to visit your local financial advisor and look at getting refinancing, increasing that mortgage. So it's in that mortgage, now it's amortized over 25 years. So the monthly payment might be easier to manage. Again, multiple options available in that arena, but that's a more detailed discussion.
Thank you. Any questions around line of credit at all, or offsetting costs, Sunil?
I just have a question regarding the damage. What kind of damage is that? Like if we have an insurance and we have a big damage, like more than $10,000, $20,000 water or something like that, is that covered? Like how? I just want to know about that. Like instead of using our own money, we have insurance. We have the water came in and water flood or whatever inside the home, in the basement usually, and is that like manageable with the insurance if we have the insurance?
Good question, Sunil. So the home insurance that we talked about, that is precisely there to protect you for water damage, fire damage, theft. I think there are certain act of natures covered in there as well. Like, for example, tornado doesn't happen over here, but it's covered in there. But you should look into your policies. But yeah, home insurance policy is there to protect you for any damage that occurs to your asset, which is your home. But there are, different companies with different coverages. Maybe it'd be a good idea to educate yourself and look a bit more into that. Yeah.
Does that satisfy? Go ahead.
So I think that means that it's very important to have that insurance when you get the mortgage. Like some people say, it's okay, not important, whatever, But I think now what you're saying, it's helpful. You never know when the water come in your basement, you never know.
I think if I was the prime minister, I would make insurance a must for every citizen, because
your wish will come true, don't worry.
You know what, just to add to that, the only thing that I would say is that I know when I purchased my house and I had to close, it was mandatory. Like the lawyer actually said that, I need your home insurance policy. And we actually had to call the insurance company to make sure we had that before we could close. And a lot of new builders will require that. So I don't think it should be treated as an option.
But I thought it was mandatory to have home insurance anyways to get a mortgage, don't know, for properties, right?
In Ontario, it is. It's not mandatory, it's not government implied, but all the banks collectively ask for home insurance at the day of funding. And if you don't have home insurance, you won't get funding.
Right.
So in Ontario, it's silent, it's indirectly imposed, and everybody understands. Let me rephrase, edit that. It's industry standard now to have home insurance on all your mortgages.
Yeah.
Yeah, I couldn't imagine sleeping at night with not having that. Honest to goodness. Wow. Another question, Sunil? I think you're thinking of something.
I just have a question. Like, if suppose like I got a mortgage for 30 years because I want to pay less money, and then I got a better job. Now I want to pay in a faster way. So what are the procedure? Is it easier for everybody to change from 30 years to 15 years or refinance, whatever the procedure is? If you can explain that, please.
So quickly in a summary, that's a great question, by the way. So, let's say you start, and I'll work with your example. Let's say we start with a 30-year amortization, and now, you make double your income, and your approach is to knock off your debt. So multiple ways we can do that. There, in a majority of the contracts in A lending, which is, your main 5 banks, you will have bi-weekly options available, or weekly repayment option. So this is the frequency could be adjusted of a mortgage even after funding to make sure there is more amount being applied into your repayment. Second tool that majority of the people use is doubling up their payment. You know, you can take your regular $1,000 a month payment and make it $2,000 a month. Now you're a payment ahead. That's another way of repaying. The third, my favorite, is majority of the banks have a certain portion that you can prepay into your mortgage principal directly, anywhere from 10% to 20% of the original borrowed amount that can go right into your principal. So as soon as the third one that we talked about that happens, your amortization will fall automatically. That's one way of doing it. Second way is, again, increasing your monthly payment will bring your amortization down. Third, again, by doing your frequency change will also bring your amortization down. Or you can just say, I can afford an X amount, but that X amount that you want to repay monthly should be okay with your lender if they allow you to increase your monthly by 10, 15, 20, or certain banks 100%.
Thank you.
Thank you. If someone wanted to pay off their mortgage early, how would one go about doing that, Raja?
You call me.
Yes. Yes.
So to repay your mortgage off early, you know, again, I'll give you a quick 101 on the products. Two basic products in the market: variable open, variable close. Variable is a product that works up and down as the economy goes up and down. Economy goes up, the rates, rates are going up, your mortgage rate will go down. That's variable open. Variable close, another instrument where the discount is there because you have made a promise to us. So prime is, call it 3%, we give you a discount. As prime goes down, your mortgage goes down. As prime goes up, your mortgage rate goes up. It's a variable product. And then fixed product. Self-explanatory, you want to have a peace of mind. You've taken your mortgage now, you are okay with the repayment, monthly payment, and you don't have any other idea of going in. Perfect, beautiful, you take the fixed product. Now to repay, why did I give you this information is that depending on the product that you would have chosen will impact if you can early pay your mortgage. So if you were in a 5-year fixed product and you come to me at a 3rd year mark, there would be penalties associated with you breaking the contract. And the penalties associated change between the product choice, fixed versus variable. So I would definitely suggest somebody that has something like that in the plan should consider talking to their financial advisor at the time of taking the mortgage to ensure they have taken the right product that's going to fit their need when they go to repay this mortgage all in one.
Such as like a 10-year increment or
5-year, 10, 15,
5-year. Gotcha. Priti or Jyoti, want to jump in? Any commentaries? No, Jyoti's saying something, I think. Yeah.
No, I think I'm all good.
No, it's all good. No, that's
same
awesome.
here.
No, thank you. It's very, very thorough. You guys are fantastic. Thank you so much. I wonder if we can take the conversation into our senior life, maybe not a sort of middle age, and sort of focusing on how we protect our seniors with financial protection and protect them from scam and fraud, and how important it is to maybe create a will and power of attorney. Anybody want to speak to that at all? I'll open up the floor.
Every time I'm closing a mortgage with all my clients, I always suggest them, if it's a husband and wife, and I always say, do a cross power of attorney to each other. In case of the unforeseen, one person is traveling, with today's world, you're stuck overseas and you can't come back, and your spouse should be able to do things legally on your behalf. And as
Right.
again, I'm going to come back to Priti's and Jyoti's conversation from earlier, from first segment. If you were investing money in RSPs, now as a senior, you are approaching, the golden years of your life, and all that money that was in RSPs compounding year over year is there, that you can, from 65 onwards, you can start drawing it out for your pension income, for your survivability. And for mortgage, the, again, largest asset in your life, let's say you started listened right, and at 25, you bought a property, and now you're 50, it was a 25-year amortization, your mortgage is paid off, and you sit on this $1 million house. You didn't put any money in RSPs. So there is something in the banking world, for simplicity, I would say it's called reverse mortgage. For terminology, it's also called chip mortgage. So what happens in that product is that let's say you have no mortgage outstanding on your house, but you say, Raj, I need $2,000 a month to survive from now until I'm, I don't know, 80. So, they will do the assessment and appraisal value, and they'll give you on a monthly basis an X amount of money coming out for you to pay your expenses and live upon, in case you don't have access to liquid funds in RSPs or pension or other investments. So there are multiple ways a senior can educate themselves to get to that level. I think the first start again is that this conversation should be getting prepared around the age of 55. Be a good mark to know that, hey, I'm approaching my retirement in 5-10 years time. Am I paying off my mortgage? Do I have enough to retire? And what kind of my expenses would look like? So again, coming back to Preeti's original point, budgeting. Budget is so much more important to instill in our society, that we should know that, okay, now I'm downsizing. What do I do? How do I manage myself and my golden years in life? Back to you.
Yeah, I would just add to Raja's point as well. So that was some really great points. I mean, ideally, when you're at that, 55, 60 plus age, hopefully you don't have such a large mortgage and you're not paying so much into, I guess, your debt. Hopefully you want to be in a situation where, you have like your cash flow coming, your retirement income coming, your pension income coming, all of those, great things. I mean, we also get government benefits at current time, but in the future, we're not sure if those are going to exist. Hopefully they will, but you just want to kind of be prepared for that aspect of it as well. And that's why, again, saving for retirement is so important, to just ensure that, when you are not working, you do have that cash flow coming into you. Yes, those reverse mortgages are there. However, hopefully you don't want to rely on those, in your later years in life. The other part of it is the investing part of it. So when you're younger, you're middle-aged, you could, you want to sort of be a little bit more aggressive in terms of like your investing when it comes to like, whether it's mutual funds or stocks or things like that. You could, invest in those type of things. But as you get older, you want to be in a place where maybe your time horizon is important and you want to kind of scale back on some of those riskier investments. I don't know if anybody else wants to add anything to that, but.
Oh, that's great, Priti. Great point.
And I just wanted to, Lynn, just exactly what you'd asked. I want to wrap up that part around wills and power of attorney. I think the only thing I want to emphasize here is, I know there's a lot of taboo around, or not even taboo, it's not comfortable to talk about end of life. It really isn't. But it is a very important aspect of your planning. So we work so hard to build a savings nest for ourselves, an estate for our family. But if you don't plan that right, what you've really built for your family is not going to get to them. That's why it's really important to have a will, to make sure that you choose the beneficiary right. If you have a spouse and things are well, make sure everything is in joint name with the right of survivorship, so that it doesn't need to go through the detailed process of getting a will probated and stuff like that. So very important to have a will. It is okay to be uncomfortable talking about it, but it is something that's must for sure.
Jyoti, can you be a power of attorney and still not have access to the account and the money?
So that's a good question. When you are a power of attorney, you can actually choose when you're drafting up a power of attorney with your lawyer, you can choose the level of power of attorney you want them to be. Sorry, I know it's getting really dark in here. So I'll just turn my light on. I'll be right back. Sorry, guys.
We're all camping together. It's all good. It's nice. We're very natural.
Yeah, but just to while Jyoti's doing that, wills are so important. Whether you go to a lawyer or, like you go to like a notary or someone that can, kind of prepare something for you. The other point to that is also you want to kind of keep it updated. So, I, for example, had a will done about 10 years ago, just to kind of, talk about or just draft something up. And I went to a lawyer, and it was more to do with, okay, if something had to happen to me and my husband, who's going to take care of my kids? Or, when do I want to sort of have them manage their own, like, I guess, savings and things like that of what we've left for them. So it was a different purpose back then of, creating the will. But as we're older, and my kids are getting older, I need to kind of update that to just make sure that it's still relevant as to what I want, right? Because as they get older, I don't really need a caretaker for them. So that's another, point to that, that even though you have a will, you kind of want to make sure that it's relevant and it's updated. I think you can go to, I don't know, correct me if I'm wrong, but can you go to Staples and get a template? Yes. Like you can buy something.
I think you can download
but I guess you need witnesses.
Online.
Now, is that recognized?
Yeah.
Yeah, it will be recognized then?
Yeah, it is. It is actually. So if I remember this correctly, they said that if somebody was dying and they wrote something on a rock with their blood or something, that's recognized too. So I know.
Or just on a piece of paper. Yeah. But I think it just has to go through probate to ensure that, it's going to be valid, right? So
the rock.
The other thing to that.
Like that. Yeah, and thank you for jumping in. Well, Jyoti, did you want to pick up where you left off there? Thank you.
Yeah, I was just going to say it's really important to have a will, that's for sure. But power of attorney, so let's just quickly take a minute to talk about power of attorney. So power of attorney is really, as the word may sound, it's really acting on behalf of someone else. While that other person is not in the ability to act on their own self, like whether they're traveling or they're just not available for whatever reason, or they could be not in a good health condition that they can't conduct their own financial business, really. So power of attorney is only good as long as the donor of the power of attorney is alive. So the minute, or basically whenever the person passes on, the power of attorney becomes null and void. So the person that they designated as their power of attorney can no longer act on their behalf. That's when the will really kicks in. Now, I know a lot of people also think that, okay, I do have a will, so no problem, things will go to my wife. But the truth be told is, if you, like I said earlier, if you are in good terms, if everything is going well, and you do have a spouse, I think to save along, the whole process of having to get the assets and everything transferred over to your spouse, I think it's easiest to make sure everything is joined to the right of survivorship. Now, there could be many reasons where people don't want to have things joined to the right of survivorship. That be told, like, that's different. But the easiest thing is to have everything joined, so that if one goes, the other one will automatically inherit, that it doesn't need to go through the whole lawyer process, the estate process, and everything else that needs to be conducted. But if it does not have to be or cannot be joined with the right of survivorship, that's when the will can practically spell it out. And when a person passes on, a family member could take a will to the bank, obviously depending on the value of the assets. Sometimes if it's quite minimal, the banks can actually make the decision to actually eliminate the process of probate. So probate is really, probate is actually a process where the will is presented in front of the judge, and that anybody who has an ability or a need to contest that. So basically somebody can actually step up and say, I contest because I have another will for this person. So it's really, probate is a process where you validate that that is the last living will of the deceased. So you do have to go through that process when there's substantial amounts of money involved, when the deceased is left behind. But if it is quite minimal, I would say, we could stand corrected, but anything less than 25,000, if it's held in the bank account. Sometimes if the customers are really known to the bank itself, there may be some discretionary, maybe a probate that may happen, but there's some really strict guidelines around that. So, the process really needs to be thought through very well. when you're drafting up your will, please make sure you included as many assets as possible. You've been as fair as possible in distributing their assets, because there's a lot of miscommunications and relationship impacts that happen after. And then lastly, also designate a trustee or an executor, I would say. An executor is a person who can actually act on your will. So if you say half of my money goes to my my son and half goes to my daughter, your son or daughter could be the executor if they're all in good terms, but there could be external influences as well that they may not be. So make sure you have an executor picked as well, a person who is most unbiased and actually can act on your behalf. So for sure, wills, as Priti was saying, it's as easy as just writing it on a piece of paper, but trust me, there's a lot of information that needs to go in there. There's a lot of thought that needs to be put into it. So if you're doing it, do it right. Speak to a lawyer. Make sure you include it as much as possible.
Also, last point to that that I'd like to make is just ensure that you're also designating beneficiaries. So if you have an RSP, you can actually designate a beneficiary. So do you want it to be your spouse? Do you want it to be your child? Do you want it to be both your kids? So that is an ability that for you to actually go into the bank and designate a beneficiary. You can do this for any registered account. So you can do it for RSPs. You can also do it for TFSAs. And that will really kind of minimize the process, like Jyoti was saying, of going, into probate and things like that. It just makes things much more simpler when there is a beneficiary designated.
Priti, you said it really well. I think the best way to wrap this up is for all your registered savings accounts, whether it's your RSP, your RESP, obviously that'll have it. But for your tax-free savings account, make sure you have a beneficiary. While you're alive, and you have a spouse or someone you feel like there's certain instances where you may not be able to act on your behalf, make sure you find a qualified power of attorney that can act on your behalf. Power of attorneys can also act when, whether you're incapacitated in a medical condition. So there's different types of power of attorneys as well. And then for after you're gone, make sure there's a will and it's very well thought about with a good executor that's picked, and an executor could be a person that you can trust will execute everything on your behalf and as per your will.
I do have another question around the will part. So can you be power of attorney and not have access to someone's account?
Sorry, so did you just say that?
Yeah.
The power of attorney not have? Yes. So power of attorney, when you're drafting up a power of attorney, you can actually set some limitations. It can be an unlimited power of attorney, so anything and everything, or you can only designate a power of attorney for a limited part of your financial being. So Raja, I'm sure you can chime in here, but people oftentimes, if they're traveling abroad, if they're selling a house or buying a house, they can just designate a power of attorney for settlement of real estate transactions only. So you know that that person can only sign on their behalf for X, Y, and Z and not everything else, right?
Okay. Just having a hard time hearing. Yep.
Power of attorney gives you right to, it's pretty simple. What kind of your right do you want to give it to somebody else? Are they going to do only closing of the transaction for you on your behalf? Are they going to make decisions if you're in, you can't make decisions yourself physiologically, physically there's something wrong with you? Or, and it's up to you what rights do you give. So there is obviously general power of attorney, which is for anything and everything. And then there's limited power of attorney, which is for a certain task or a certain transaction only. So I definitely suggest, power of attorney and wills is a very important message, and you should probably consider talking to a lawyer close by.
Nice. Yeah. Yeah, no, for sure. Thank you. Very, very thorough, all of you. Thank you. I wonder if before we wrap up the program, if we could talk just briefly on scam and fraud for our seniors, and how do we protect our seniors from fraud in the banking world?
There is a lot of fraud going on right now, especially in the digital world that we live in. So, there are a lot of tools available where, we can share with our seniors, letting them knowing that, like, the basic one that I'll tell you is nobody or if anybody on a financial institution or a government organization asks you for your password, it's a fraud. If somebody's asking you to enter your information on a website that may appear like a real one, but if you look at the top part of your bar, it would show you where you're entering information. Pay attention to that. But you know what, right now, I know there's a couple of places they offer, free online security courses. Maybe that would be somewhere to start. But yeah, seniors have to be extra savvy of sharing their personal PIN code and their account information with anybody that they don't know. Similarly to a real world, you won't share that with somebody. Be more careful when you're sharing it on a digital world.
And commentaries from Jyoti and Priti? Thank you.
I think that sorry, so I'll just add to that. As family members, I know we have our parents, we have relatives or people in our community that we know are entering or living in the golden years, or not even that. I would say anyone. If you hear of something, just talk about it, raise the awareness. I think that's really important. I know sometimes I could just speak for myself. If I tell my parents not to do something, it's just not that easy. So you kind of also have to build a story around it and tell the whole premise, where it comes from and what really happened. So I think we need to be patient, but pass on what we hear. Very important. Awareness is really, really important. The other thing I was going to say is not just seniors, I think for all generations, keeping a good line of sight on the banking activity, checking your bank accounts, checking your credit card statements often every month is very important, because again, you can ignore it and continue to move on and let these fraudsters take benefit of you, or you can be smart and keep a good track of your account and just stay one step ahead. So all I would say is just there are tools, just like Raja was saying, there's digital tools that are available that can help you track any of those, unauthorized transactions. So leverage those, check your bank accounts, and raise awareness.
Love that. Sunil, question?
Just a question, like if some senior person gave a check to somebody for like more than $10,000, and that person goes to the bank, the bank check the ID and stuff, and they just give the money or something. What is the procedure and how we can protect that? Maybe it's a scam, you don't know, somebody stole the check and do this, whatever. How we can protect that senior in that way? Is there any things right now are available for them? Like somebody can call or somebody check, or how it works? Like, because it can happen to anybody, right?
I can take that one. So Sunil, basically what happens is when there's a check presented, and it doesn't necessarily, like for a senior person, but we do have, when we take that check in, we determine whether that check, we need to hold that check or not. And what we mean by that is that we will deposit it, let's say, to their account. However, we'll put a hold on it for 5 days, meaning that that customer cannot have access to that money until that check clears. So that protects the consumer or that customer to ensure that if that check was fraudulent or anything like that, then that check would come back as fraud, and then we would just simply, kind of let that, the person know that it was actually fraud. The other tools that, different banks probably do have, and I can speak for mine, is that it's something called check verification, which checks for authenticity of a check itself. We typically do that for checks that are over $10,000 in value, or more than that. We wouldn't do it for anything typically less, unless it's very unusual. But the main thing is that we would hold that check just to ensure that, it is, kind of gonna clear or not. And that's also to protect the bank, to ensure that, the customer that's depositing that check doesn't actually go and spend it right away, kind of thing, right? So those are some things, but unfortunately, when they presented that check to us for $10,000, it's probably in most cases already too late. And that's why it's really important that, our seniors are very diligent when it comes to, kind of buying into some of these scams, right? Like there's a lot out there. We see it all the time. I think it's getting better where people are a little bit more diligent and, you know, more knowledgeable when it comes to these kind of things. Typically, if it sounds too good to be true, it normally is. So, so that's what I would say about that. I don't know if I answered your question.
Yes, thank you.
Speaking to your point, Priti, as well, just with some seniors locally that I know of, there's been a couple of situations where they've shown up at the bank to withdraw money, but the teller has cut them off at the pass because they picked up on it being a scam situation, right? So the teller being attuned to what's happening, right?
Yes, yeah, and we encourage our staff to ask those questions. You know, if there is a large sum of cash being withdrawn, or if there's a wire, funds being wired to, you know, let's say a different account or a different country, we do actually ask those questions as to what the purpose is. We have caught people where, you know, they kind of tell us the story, and, you know, we're like, well, you know, that we don't, you know, recommend that you send this wire because it doesn't sound right. So definitely that is there where we, you know, try and do our best to safeguard our customers that way.
That's awesome. We're coming near the end of our program, and I know if anybody wanted to get into the field that you're working in right now, what would you recommend for them? Words of wisdom if they wanted to study financial in the financial world. Who wants to take that one? We've got lots of experience on our panel, so.
I'll start quickly on this one. So before we do that, building on Preeti's point, there is, you know, with Equifax.com, which is a company that maintains all of our credit bureaus for us, would be a company, they have a facility where you can put a phone number on it. So in case somebody ever tried to take over your identity and applies for, let's say, a mortgage or a credit card, that phone number will block any lender to not lend any money until they call there to confirm with you that you have actually applied for something. So equifax.com.ca, go there, set up yourself, you know, with your phone number. So before anybody would borrow on your behalf, they need to call you on your cell phone or your home phone, whichever number you describe. Second point that I really want to quickly wrapping it up. I think this is amazing thing that you guys are doing to bring the whole community to know and talk about these basic information. You know, when I came in this call, I was thinking, you know, how basic am I going to get? But I can understand that, you know, a lot of, you know, even, you know, we do this day in, day out. So it's a norm for us. But for somebody that does not, it's a huge thing. So keeping it very basic from, you know, like, you know, my fellow panelists, you know, they've done such a great job talking about from a young age, building the right system, budgeting, and knowing where you're going are three things that are going to help you have a financial success in any field that you choose. And passing it over to you guys.
That's very nice. Thank you so much. Oh, anyone else?
I think, Lynn, we should have a sheet for the tips.
Yeah, we do.
With the program, so everybody can look at the tips and make sure we're going to give the information about Paul over there, so people can call him any mortgage question. If they want mortgage or anything, why not? And people can hear him and bother him and help him.
And you know what, thank you for sharing those links. We can't wait to put them up for our viewers, because it is about that, sharing resources in our community and knowledge, right? And shining light on all these opportunities that are available to us. Thanks, Sunil, for mentioning that. I appreciate that. And anyone else wanted to comment at all?
No, I echo what Raja was saying. I think this is a great platform for everyone to sort of learn. You know, happy to share anything, you know, anyone wants to know in terms of like our experience when it comes to financial literacy. Again, we've talked about like the importance of, you know, how important it is to save, budget, you know, potentially buy a home and, you know, be financially secure in your retirement years. The only other thing that I would say is that, you know, I thank you guys for kind of putting this show on the road, kind of just to help the community. So
thank you both. Thank you.
I totally echo what both these Raja and Priti said.
That's awesome. We're just thrilled to host you, and thank you for enlightening us. Sunil, you wanted to comment?
No, I just want to say that I also learn a lot of things which I don't know, some points, but this is a good advantage for the people to understand the basic small things are more important than the big things.
You're right.
If you follow these steps, like from the childhood, everything, life is smooth in some ways.
I love that. Well, what can we even add to that, Sunil? We'll have to just I think that's the capper right there. Thank you. No, that's awesome. And I want to thank all of our guests for joining us today on discussing financial literacy. And thank you to Moksha Canada Foundation and our founder, Sunil Channon, for allowing us to do this and being a part of this process of learning and growing together. Reach out to Spotlight on Community, reach out to Moksha Canada Foundation, get involved. There's lots going on. We have great festivals coming up. We have other shows that we're doing, other topic matters. Come on out and see us, message us, whatever it is you'd like to do. Moksha Canada Foundation, Spotlight on Community. 1,000 thank yous for joining us.
I'm just going to add something else. We're going to share all the links below. So please go and watch it.
Awesome. Bye, friends. Thank you so much.
Take care.
Thank you. You as well.
Bye-bye.
Thank
Thank
you.
you.
Bye.